Mike, give me some perspective.
Well, I'm trying to figure out where the import prices come from. Obviously, you look at export petroleum, and it's up 0.1%. It looks like we did see oil prices fall during that month. They're back up again, but that may be the biggest reason that we see import prices for this particular month. But I do want to go to this chart here of G, hashtag BTV1297. This is the trade-weighted dollar, and this is what's been really affecting import prices. The dollar has fallen, import prices go up, oil prices go up. And it doesn't show any signs of breaking out of that, which is a little unusual because given the outperformance of the U.S. economy, you would expect more people buying dollars to get into U.S. securities, and it hasn't happened. So that's a bit of a conundrum for the Fed going forward.
Well, also, interestingly enough, taking a look at, say, auto prices actually were down 0.2%, and then I bring forward, walking it forward to potential sanctions, how that winds up impacting and what that does for consumer demand and how that translates. Yeah,
if you do have trade sanctions, that should be an inflationary move, but it'll be a short-term thing. It would come through once as the companies pass along their price increases, and then after that, the question is what happens to growth. And the Fed, in the minutes yesterday, apparently discussed that at their last meeting, suggesting that they'd be more worried about the growth impact than the inflation impact.
Absolutely. And that leads us to our next conversation, which is a number of participants, this is the Fed minutes, indicated that the stronger economic outlook activity, along with their increased confidence that inflation would return to 2% over the medium term, implied that the appropriate path for the Fed funds rate over the next few years would likely be steeper than they had previously anticipated. Laird, if you're looking at a potential steeper rate hike world, where does that leave us with 10 and 30s?
Well, I think it leaves us with a flattening curve over time. I think what you're going to see is that normally at the end of the cycle, and this is being very well telegraphed by the markets, that the curve flattens, and we're seeing the curve sort of move towards a flattening position near 3% yields. I'm not surprised that the Fed is saying that. I think the question for the Fed is, if not now, when? We have a synchronized global expansion. We have very low unemployment, as you just pointed out. It seems like this is the ideal time. And if you're a risk manager on the Fed, if you think about managing your personal risk in terms of how to handle this, this would seem to be the ideal time to give yourself a little bit of cushion, raise rates, and be ready for when the deleveraging occurs, when the economy rolls over, and you have to go in the other direction. You give yourself some leeway to actually have policy effectiveness in that type of environment.